all CEOs, me included, we don't actually know what we're doing.
They're all sharks, so all you got to do, though, is know shark behavior.
I don't think we've ever talked about this before.
We can capture all of the wallet share.
First place you start is with the product.
That's just the first note.
This is the Capital Stack. Hey everybody, this is David Paul, the host of the Capital Stack podcast, where I talk to founders, operators, and investors about all things value creation in startups. Today, we have a very special guest. I am talking to Aaron Oakes, who is the CEO of United Pet Care, which is a alternate type of business model within the veterinary space. We all in the startup land talk about software companies, marketplaces, gig economy, blockchain, Coinbase, and we sometimes forget to look at innovations within business models and the importance of that. So we're going to be talking a little bit about United Pet Care. We're also going to be talking a little bit about something called a search fund, which is how this investment came to be. So with much ado, I'd like to present Aaron Oakes. Aaron, how are you doing?
Doing great, David. Thanks for having me on.
Thank you so much for coming on. So Aaron, I'd love to know a little bit about yourself and your backstory and how you became a search funder. And what is a search funder?
Yeah, absolutely. So reformed consultant, and after about a decade advising and waiting for the door to close and other people to make decisions, kind of decided that it was time to bear some risk and take ownership of decisions myself. So left a job in corporate America, always had the entrepreneurial itch. And actually my journey started, or interest started in the pet space, and that kind of spawned the interest in search. And I'll talk a little bit about how that operated. So I left actually to start an unrelated business, and doesn't register in the grand scale of COVID sob stories, but made it about 10 weeks and then the winds changed. And my wife and I actually both ended up with a little bit of a professional reset and had
10 weeks. What happened in 10 weeks?
So started the business about 10 weeks before COVID.
Oh,
and
which business was it?
So it was a small real estate investment fund.
Got
and basically
it.
capital went away. It became impossible to get debt. Yeah, exactly. And my wife actually also got laid off. She was in a corporate job. And so we, were fortunate enough we could take a little bit of time, and we said, hey, what are we passionate about? And where do we see opportunity in the heavy air quotes new normal? And we had adopted a pandemic puppy, and just about everybody we knew had. My running joke, the 4 horsemen of COVID are you either got married, got divorced, had a baby, or adopted a pet. Basically touched everybody between the ages of 20 and 50. I agree with that. And so, we started looking into the trends and actually did, through an SBA loan. So this would kind of be called a self-funded search. We were just looking for businesses specifically in pet, within Phoenix. We had relocated out here for my business, and, that we had an ethos that we stood behind. So we went through that process, acquired a little retailer, that my wife now runs. And after about 3 months, she booted me out of the business. I was no longer being helpful. And so that was when, I'd kind of fallen in love with the industry and wanted to find a business model, that was a little bit more aligned with my skill set and my experience. And so just to take a step back, the concept of a search fund is one entrepreneur gets some capital in advance and gets that committed capital regardless of the business. There's some parameters, of course, around revenue profile and industry and things like that. But then that person actually just spends a significant amount of time identifying that one business, which they will both go through the diligence and acquisition of, and then also operate. In my case, it was a little bit of a modified structure. So the capital had been lined up by another individual, and they were in about the 7th, 8th inning of the acquisition, knowing that they were not going to operate it. But we found each other while they were pretty late in the process, with the, operating model that once the transaction was completed, I would take over.
So, okay. So how does one choose a search funder? Because I'm sure this would be something that every entrepreneur and their mother would want, is like, hey, just have a bunch of rich guys help me find a business, right? I mean, like that seems too good to be true. So like, how does one pick a search funder and become, I guess, search fund quality?
Yeah, it's a great question. I mean, there are some pretty well-trodden paths. And so I would say most typically that's somebody who's coming directly out of business school. There are communities now that have started to blossom, particularly within Stanford, Harvard, some of the, top tier business schools. And these investors have, as you would imagine, are incredibly data driven. And so there's a set of characteristics, both, kind of from a resume perspective and then also psychographic in terms of, the type of entrepreneur that would make a good search funder. It is a very different operating model and a very different kind of calling than starting something, VC. It's much more singles and doubles than it is, home runs, and the flame out rate typically is much lower. So the idea is find a business that's been operating incredibly well, but maybe within a geographic limitation or, other constraint, because generally if you don't have professional capital as a founder, you're, living off of the EBITDA, and there are just some other kind of constrictions associated with the business. But the kind of flip side of that is typically much lower growth rate, oftentimes blue collar industries, kind of these operating businesses where most of the return is actually from an expansion of EBITDA multiple as opposed to massive growth. Mm-hmm. So it also takes somebody who is interested in truly getting their hands dirty in an operating role, and is, fine with maybe a little bit longer time horizon and maybe a tighter band on the potential outcome vis-a-vis, starting something on your own.
Yeah. So like a sadomasochist, right? Kind of profile.
That's right.
So the psychographic profiling or the founder, or excuse me, the entrepreneurial traits, like what did that look like? Because, people are generally younger in their career, they don't have a giant work experience. I'm sure you had consulting, of course, but like what kind of stuff are they asking you? Is there psychological tests that are happening? I mean, are we doing like deep reference checks?
Deep reference checks. So there were guys that were reaching out. I mean, LinkedIn is a beautiful thing in that regard. And I was hearing from folks, 10, 15 years ago that were getting pinged by the investor base or the board as I was going through the process. I would say also from a personality inventory, I took predictive index. And I think one of the longer ones where they actually have it, arbitered by a professional. So they take it incredibly seriously. And, as you would imagine, so much of that hinges on that marriage between both the board, the investor group, and the CEO, but also the CEO and the business. And the instance of the, kind of host rejecting the organ can be really high. You can have somebody who comes in with all the right ideas on paper.
The host rejecting the organ. That's really interesting. I love that terminology.
So just in the case of, United Pet Care, my business, it had been operating since 1996. And a lot of the staff, I think the average tenure was, 7 or 8 years, if not higher. So you have to be really cognizant of coming in and, kicking out tent poles because you don't know which one's holding the tent up.
Exactly.
And I think that's really what tempers a lot of folks who typically work in, private equity or other kind of high achieving careers where you just kind of go in and assert things, and it takes a little bit of softer touch.
Yeah. You have softer skills for that. And you don't know where the bodies are buried, to your point, and you can't have everybody walking out either.
That's right.
Right.
Yep.
So you have to have somebody who's got those soft skills. I think that this is really, I'm putting an asterisk around this because I think that the venture community, the growth guys like myself, could probably take a really good lesson in the search fund community's book on founder selection. Because, generally we look at, okay, what is the founder in relation to what they've built and how much traction they've had? And that kind of overshadows like the personality, the soft skills, all these other kind of things. And I think that when you're dealing with, the business being a different entity than the actual operator, it's a different lens to look at somebody. And I think that, as a search funder, you have to, probably dig a lot harder on the founder or the operator aspect than a VC does.
There's no concept to hide behind, right? So that's kind of you got to stand alone in the spotlight for better or worse.
Yeah, that's very interesting. I'm going to definitely pick your brain later about that. And so you were saying, so you went through the process, you went through all the background checks, they selected you, and then on parallel processing, United Pet Care was also being evaluated, so you didn't have to find the deal?
That's right. So yeah, I did get lucky for sure. And from a lot of folks that you talk to in the search process, that is the most kind of psychologically grueling. You're basically on a 24-month time clock with this capital pre-committed and obviously some significant expectations associated with it. And so you're, kind of on an island during that time. And, it is also it's a very disparate skill set from actually owning and operating a business. And my partner on the search front, he actually was a former searcher himself and very successful, both found the business and exited it, but realized, by his own admission after the fact that he didn't want to be, the boss of 30 or 40 people ever again after that, wanted to run a really lean team, and his energy and his capabilities kind of lended themselves more towards the search side than the actual operating side. So it definitely takes a very special person to marry the two of those. And I feel fortunate for the working relationship that I have with Alex, and, also the fact that I kind of got to skip the process a little bit and come in when we were already pretty close to identifying and finalizing the transaction.
Do you know the numbers of any of, searchers that successfully are able to get a deal done?
Only 7 out of 10 actually during the 24 months successfully complete a deal.
Okay. And then, so what, is there a process for like obviously the money guys have to approve the deal, right? You just can't.
There is. Yeah. Yeah. So there, obviously they put some guardrails in place from the get-go in terms of, general deal size. There are a handful of banks that will fund the transaction at least partially via debt. But, they've obviously got some restrictions on ratios and things like that. And then in general, I would say it's the, recurring revenue profile. There's some industry preferences, things like that. But for the most part, again, kind of very different than the, traditional venture world. It's not necessarily that growth is what's being solved for. It's a stable, highly recurring revenue base and a pretty strong thesis in terms of, either improving operations, not the private equity, kind of come in and cut costs sort of thing, but really truly professionalizing operations.
Yeah, bring real value.
Yeah, exactly.
Don't financially engineer something, right?
you said it, not me. But even things like GAAP compliance, right? So like the business didn't have any real GAAP approved financials or anything like that when we came in. So in some cases, you're really building something from the ground up. And, in other cases, and maybe in parallel, you're saying, hey, how can we take a really good concept and then put rocket boosters on it?
And so can you share, not particularly like the peculiars of your deal, but like what is the general search fund deal that, gets struck between a searcher and the sponsors?
Yeah. So typically I would say one from a business size perspective, it's, anywhere from $1 to $5 million in EBITDA, almost always a complete, takeover. Maybe the seller will roll a little bit of equity, but in general, as you would imagine, new sheriff in town, it just makes it a lot easier for there to be a hard break or for the seller to have an advisory role, if anything. And in terms of the relationship with the LPs, there's a, preferred equity stack, just like any other deal with a rate of return that's promised or and then basically the searcher starts getting paid after that pref is realized.
Okay, got it. So there's basically a pref, and is it like a cap table type of situation? So it's not like a profit sharing. So there's like an ownership stake of X amount.
That's right.
Goes in. Okay. So there's like an IRR threshold that these guys have to hit, and then I think above and beyond you share pro rata, I'm guessing.
That's right.
Got it. Okay. Cool. All right, so let's talk about United Pet Care.
All right.
Yeah. So tell me what that was, and what's the business model, and what's interesting about it today.
Yeah, United Pet Care is an incredible little business. And honestly, it was the business model that I was looking for that I didn't think existed in an industry that I already had kind of a personal draw to. And so basically, we are an HMO for fur babies. So kind of an innovative concept, at least within pet. We're an alternative to traditional pet insurance. The way that we operate is we partner with a network of veterinary providers across the country and go pre-negotiate rates on behalf of our members. So the value prop to the vets is, we go source them high value, sticky clientele. The other side of the network, we distribute exclusively as a voluntary benefit that employers offer their employees at time of open enrollment. Typically that's an unsubsidized benefit. Some employers choose to subsidize it, but you're kind of going through that same psychological motion as when you're picking dental, vision, other, critical care things, benefits for your family. We try to be, right in that same psychological motion.
Okay. And so like, how is this different than like a pet insurance, right? That kind of like the Trupanions and, the ones that, what are the other ones that are publicly traded? Trupanion and...
So Nationwide is one of the big ones. Actually, very few publicly traded. Trupanion, I think, is about the only one. Okay. ASPCA is another big one. JAB has actually, the private equity firm has been rolling up a number of pet insurance providers over the last 24 months or so. But those are, in the benefit space, those are kind of the big ones. And then there's been a number of startups. Typically, they're all underwritten by the same like handful of 2 or 3 providers. And then it's just whatever, color palette you choose for the marketing. Yeah, exactly. So the major difference is we don't underwrite. So we don't bear risk. We're not a regulated product. That manifests itself in a number of different ways, but effectively, we are just connecting the pet parent with the vet by virtue of this membership network. So we're very careful in, any marketing materials to not use any insurance language, things like that. But that's the major difference. And, some of the implications of that, typically for pet insurance, you have to be property and casualty licensed to distribute it because it is a P&C and fully underwritten product. Also from a regulatory perspective, there are loss ratios and things like that are, kind of restricting the environment. Pet insurance writ large is still kind of finding its footing as an industry. So even with some of the pretty wild trends in terms of the number of pets that have come into American homes, and now the fact that they're not pets, they're fur babies, they're riding around in the strollers. Millennials consider them to be starter children. Adoption rates are actually still pretty low. So right now, only about 4 to 5% of overall pets are protected in the US, lagging sorely behind most of the rest of the developed world.
Why is that?
So, right now, a couple of different hypotheses, but right now the model typically doesn't offer a lot of value to the consumer. Reason behind that, other than us, nobody is negotiating rates with providers. So obviously in the human health insurance world, which has its limitations as well. A payer is going to a provider and saying, hey, we're going to go bring you volume, but you have to accept, 30 cents on the dollar. Right now, pet insurance companies actually pay vets at the cash rate. So the only way that they make money is by collecting more in premiums than you would have paid out as a consumer. And typically the way that plays out is through restrictions to the policies. So I don't know if you have pet insurance on your dogs, but if they're of a certain breed, so like labs, hip dysplasia is typically not covered. If you're, short nose, anything related to respiratory. And then once something is, identified as a condition, either breed specific or pre-existing, there's no coverage for it.
Okay, so basically, so who benefits from the payer requesting negotiated rates? Is the consumer benefiting?
The consumer,
the consumer would ultimately benefit from that, from having insurance.
That's right.
Because their insurance will effectively cover it.
Yep.
Right.
Or lower the bill. Yeah.
Right. Or lower the bill. Why do people buy it then if it's not? If they're paying parity?
Yeah, I mean, the reality is most people don't. But for those that do, it definitely is it's just an exchange of dollars. So it's a more predictable flow of funds out as compared to, the reality of a vet bill is it can be incredibly high and very unexpected. And so there definitely is still value. And I tell anybody who listens, for a certain percentage of pets and pet parents, insurance is a fantastic product. True Painting is a good example. They have a really good 90% coverage, $200, $250 deductible. And that's very different than our program. So if, God forbid, Fluffy...
$250, that's what you pay, right? You go to it. That's a typical vet visit.
It would be for like wellness and things like that. But, if you got into surgery being required or overnight stays, I mean, vet bills can get into the, $5,000, $10,000 very, very easily. And I think what a lot of people don't really appreciate is, vets are doctors. They are on average incurring about $250,000 in medical debt. The equipment that they use is either very similar or the same. Yeah, exactly. And so, it's this kind of constant struggle in America. We want the best, highest quality, but, we don't want to pay for it. And, the other...
Especially when it's cash.
Yeah, exactly right. And, the other sad thing is pet health follows human health. Now, unfortunately, a lot of the chronic diseases that have kind of manifested in us over the course of the last couple of generations, chronic heart disease, diabetes, things like that, are now actually starting to show up in our pets as well.
Interesting. Okay. And so United Pet Care is different in the fact that it offers a membership, essentially saying, okay, when you come here, we are negotiating rates. Right. And so how does that look, and how does that, manifest itself to the consumer? Yeah. Does that mean, is it like basically professionalizing wellness plans? Is it like kind of preventative?
That's a great way to look at it.
Okay.
Yep, absolutely. And that's why I view our product as complementary, certainly at an employer level, but definitely at an individual level with traditional insurance, because what we do, our ethos as a company is trying to reduce financial anxiety around a trip to the vet, so that people go in more often, so that the animal doesn't suffer during the interim, and that they receive more and better care. And so the beauty of the program is you can see on our website exactly what every provider is offering as a percentage off, and so you have a good sense of going in exactly what you're going to save and what it's going to cost you. So you don't have to pay the entire bill up front and then wait to get reimbursed, because we don't reimburse.
Yeah, it's not like a super bill, right?
That's right. Everything just kind of appears at time of checkout. But back to the wellness analogy, we will never cover 80, 90%. The plan is typically about 25 to 30% off of whatever the vet does in-house. So it's very different. But if you did, if we're fortunate enough that you could afford both our plan and insurance, that vet bill gets reduced before you turn it over to your insurance company. So it would contribute less towards your out-of-pocket maximum, maybe your copay, things like that.
Yeah. So you really are offering a really great preventative, forward-looking type of behavioral change, really. I mean, I've seen so much. Everyone loves their pet, but keeping them. I mean, we invested in an appointment reminder system that of, Pet Desk. Back I think in 2016, and the whole genesis is just like, let's be more forward-looking. Let's extend pets' lives by actually creating a line of engagement with the veterinarian. And I think that is the big disconnect, is that people really don't have a good line of continuous wellness with their pet.
That's right.
And then all of a sudden, you come back and you've got, a mangled mouth when you could have done dental work, once a work.
Little problem becomes a big problem. And then unfortunately, a lot of times the way that plays out is it becomes a problem that's outside of the financial reach of the owner. And so there's roughly 500,000 cases every year of financially motivated euthanasia. And so that's when the vet identifies a procedure that doesn't even count that could improve the pet's life. This is just to save the pet's life, but that person can't afford it.
It's too expensive, right? Yeah. So tell me, you started this business, or you entered this business 2 years ago, and you've been growing at a really significant clip. So tell me, what is it like operating this business, during and post COVID right now? I mean, that's got to be pretty interesting. And then talk a little bit about just how the veterinary market, for those unfamiliar with it right now, like how it's shifting right now, because there is a lot of shifting and money moving around. So I'd love to kind of get your take on that.
Yeah, absolutely. So to the first question, it's better to be lucky than good, for sure. And all credit to Alex and the fund in doing the diligence, but I think all of us underestimated the tailwinds that pet benefits would represent in this very specific, like 2 to 3 year time period. So just with 23 million pets entering into American homes, and then a lot of people, foregoing or delaying. I heard someone say that babies are the new exotic animals. They're super expensive, and you got to be a little nuts to own one. But now everybody's got fur babies, and my favorite stat, now a greater percentage of the American workforce require pet care than require vision care. Yeah.
I wish I had more pets than like subtract kids and add more pets. Like I've got 3 kids and 1 dog. I wish I had 3 dogs and 1 kid.
Yeah. I think there are exchanges where you can make that trade, but you shouldn't publicize
my life would be
it.
a lot easier if I could just, move some stuff around a little bit.
Absolutely. So that's been tailwinds that we certainly never expected. But I will say, there's always a countervailing force that's represented as headwinds in the vet market, because for a long 2 year stretch, if you were a good vet, you probably were on a 12 to, sometimes even longer wait list, or not accepting new patients. So that's now started to come into balance a little bit more. Again, kind of a perfect storm of everybody adopted a pet. They typically were younger, or because they had been bred. And so that's the second most care intensive phase of a pet's life. And then also everybody was working from home. So, not to be gross, but that vomit that would have gotten eaten up by the time you came home from work, you see that now. You're a helicopter millennial pet parent. And so now that's a vet visit where ordinarily it never would have been. So that's now starting to subside, and trying to manage really a two-sided market where the demand is so high on one, but then your constraint, the supply side, is, a little bit apprehensive about even accepting any new clients, let alone
they're booked.
Taking a haircut on new clients. It's definitely been a very delicate kind of growth story to try to thread that needle over the course of the last 2 years.
Yeah. Well, anything worth doing is hard, right?
That's right. Yeah, that's exactly right. And it's a moat too. I think that's how I kind of remind myself is you got to build something with sustained value. Otherwise it's going to be just an Instagram ad blitz or something like that. So that's why the business and we have intentionally chosen the employer market to try to find those relationships that are a little bit more durable and a little bit higher barrier to entry to sell into a large corporation as opposed to, selling to an individual consumer.
Yeah. And how I actually got in touch with you is I remember I was walking my dog and, I was thinking random things and I was like, well, why isn't there an employee benefit for pets? And I called my buddy Brandon over at Pet Desk. He says, well, there is, right? There is. Yeah. You should talk to Aaron. It's actually like, next door to you. So I was like, oh, thanks for telling me. But yeah. I'd like to have been in this business a while ago. But so what about as far as like the industry consolidation and how that's playing with the dynamics of patient care? And I mean, like we saw when we invested, I think there was 27,000 vets, if I remember correctly, and maybe 3,000 or 4,000 back then were corporate.
Yep.
And now we're looking at a 50%. A consolidation rate within the next couple of years. Are those numbers correct or refresh me? Yeah.
And the pace I think has slowed a little bit. So it'll be interesting to see if they hit that 50%. And it is, so it's very interesting. I came from the human healthcare world originally and just seeing how that's tailed. I mean, it was specialists in human healthcare and then obviously all the hospitals kind of merging. And now you're actually starting to see some of those, they're either divesting them or they're realizing, hey, you actually have to have an operating thesis and you can't just roll these things up and, assume that it's going to pay off into perpetuity. Yeah. Especially when you're paying 15 to 20 times earnings, which a lot of clinics kind of at the height of the pandemic frenzy. So, what I like to say now is, and this is not universally true, but if you have not been acquired by a consolidator, it's either because you don't want to or because you can't be. And so there are a lot of fiercely independent vets. And as you would imagine, probably 70-75% of our network are independent vets, folks that say, hey, I want to go toe to toe. I'm not ready to sell out. I don't want to be anybody's employee. We help kind of level the playing field.
Are those like single practice docs,
it can be single practice docs all the way up to, there are quite a few that have established what, I would call kind of a strong presence within a market. Bad example because they just sold out, but AZ Pet Vet, actually, they had 22 locations and they were independently owned. It was kind of a co-op or a collective owned by all the docs, but actually kind of fascinating. Again, the bridge between human and pet care. Aspen Dental Group has rebranded as the Aspen Group, branching out into non-dental verticals, and they acquired AZ Pet Vet.
I did not know that.
Yeah, pretty recently.
Okay. So you think the consolidation's slowing down, which I agree it has to, right? With interest rates coming up, that's math. But I feel like there's just fundamentally just something that has been, I don't know if the industry can handle the growth, and how I'm looking at it now is, there was a lot of unsophistication. There probably still is within vet. Like you go into a veterinary clinic that might have 5 or 6 docs, right? So like a decent size practice, smells funny. The waiting room's very small. They still have a ton of charts. There's 3 receptionists that are fielding like 15 people in the waiting room.
Yep.
Constantly busy. They have gmail.com email addresses, right? And that's the industry, right? That's a lot. And then there's, a lot more forward thinking ones and they have been rolled up. And there's the rolled up ones, there's not really like cost efficiency. I mean, that I see that's, demonstrable enough to justify the valuations that they paid.
Yep.
Right. I mean, you can back office accounting, but it's really hard to back office HR and recruiting because these markets are all very different, and then operationally within these vets, there's still just so much inefficiency.
Absolutely.
Right. And then, so like, what is these inefficiency within the vets and how does that get broken?
Yeah. I mean, I think there's kind of three ways that you win. You can increase the operating capacity of the clinic, and that's addressing those inefficiencies. And that's everything from scheduling to client engagement. So obviously Pet Desk, where they sit very centrally, that's a place where we really lend ourselves as well. Just the ongoing marketing to pet parents and also quite honestly, patient and client selection. And so, one of the other ways you win is increasing the average transaction. And so somewhat counterintuitively, even though we're taking a little bit off the top, or asking the vet to negotiate on the rates, on average, our pet parents spend about 3 times the national benchmark on pet care. And so you do get a lot of folks that come in and say, okay, check up and here's the 4 or 5 things. It's a little bit like taking your car in and then you go, maybe I can ignore those and I'll just come back next year and see if they say it again, instead of someone who's really proactively invested in their pet's care. And through insurance or through our products, it's going to say, yep, I'm going to take care of those things and get them on the meds and go do the labs and the types of things that ultimately are, much better for the animal, but also financially accretive for the vet practice.
Right. And so you're getting better clients, more high margin clients, right, that are coming in. And then, but what about just the capacity issue? I mean, I don't know if the answer is we need more appointments, right? I think the answer is how do we see things through? How do we, I guess, see more patients in the one clinic? What is it? I mean,
yeah. And there is a very real kind of structural limitation in terms of the number of vets. So I think now, I don't remember the last statistic, but it's like 9 or 10 average open positions for every available veterinarian. Unemployment rates are like less than 1%. So even in a historically tight labor market, vets are a couple standard deviations lower than that. But there's also quite a lot of burnout in the industry. And actually it's one of the worst for mental health for a whole number of reasons. Yeah. Suicide is, there are, big support groups and things that have come up. I think a couple of ways that solves, I think, again, very akin to human healthcare, empowering non-veterinary technicians and veterinary nurses to see a broader range of patients. I'm painting with a little bit of a broad brush, but a lot of veterinarians insist on seeing every patient themselves and doing kind of that full breadth of work. And that just is not sustainable. So there are some very good, kind of practice benchmarks around the ratio of vet techs and veterinary nurses to doctors. That's certainly a place where I see an opportunity
reskilling
to actually staff up, upskill, exactly, and kind of broaden that range. And I tell you, if it's intersected with obviously hiring the right staff, but also the right technological support so that pet parent feels like they're getting a premium experience. I mean, you don't think about it at the dentist where you have a hygienist that's seeing it, as long as you know that you're getting the report and kind of.
No one cares.
Yeah, exactly. Yeah. And so I think that's kind of that's certainly one old behavior that needs to be, loosened a little bit. And I do think that's where having, professional investors and operators coming in can kind of help move that forward a little bit.
Yeah. What do you think about the new type of clinics, the de novo clinics that are coming up, like the small doors? But that seems like that's a cultural disruptor.
Absolutely.
Of the clinic. So.
Absolutely. And, there are a couple, obviously there are a number of them that have popped up, but that are seeing really good uptake and, retention rates for their vets. So a couple of buddies of mine, one Good Vets out of Chicago, they actually have a shared partnership model. So the vet gets some skin in the game, kind of de-risk that entrepreneurial operating model. So you're not just hanging a shingle with no hope. It's somebody where you have that back office support, but you also can participate in the upside. And, honestly, it's also been a big, the way that veterinarians are treated and that staff are treated. Another friend of mine operates, they're called Sploot out of Denver, and they do Sploot. Yeah. They do urgent care, also primary care
I couldn't think of one business that needed a rebrand.
Yeah. That's the sound that it makes when he boops a dog's nose. I think that's the Sploot. Exactly. Just kind of thinking about the model differently, and also their approach to staff retention and kind of putting the veterinary staff at the center, because a big drain on veterinarians is having that revolving door from a staff perspective. And so keeping them happy, treating them right, compensating them above market. Those are certainly places where I think the model has started, that new age model, and they can do that because they're more productive overall, because it's tech enabled, because they've got the waiting room experience down, they've got good patient flow. So it's really difficult to have one without the other. Typically, margins in the industry are terrible. So it's not that these high fees are actually mean the vets are getting rich. It's like 8 to 10, 12% margin. And a big part of that is because there's just this operational inefficiency that's a dredge. Yeah. Exactly. And so, it's chicken and egg, but you can start to pay everybody better and treat everybody better when you know that you're able to get throughput that's 30 or 50% better than a typical clinic. And that's where I see, they're varying degrees, but that's where I see these new kind of new age type of de novo clinics really being successful, even down to like the site design, right? And being very intentional about that.
Very intentional. I mean, it's so funny. Just, I've never seen a front office of a vet work efficiently. It's just like it's a battleground.
Yeah, yeah, absolutely. That's absolutely right. Yeah.
So if you're taking a look at 10 years from now, right, and if we're going to say like you're going to throw a prediction out there, and you're looking at the tea leaves, where do you see the market as far as independents, consolidators, and de novos? And like, how do you see like, them taking the market, and how big of a slice do each of them have?
Man, so I definitely think you'll continue to see consolidation, but I do think it'll be a much more even split between these new kind of smaller, leaner players. Now, the ultimate question, 10 years is a long time. Ultimately, probably several of those de novos are going to start to sell out to the consolidators anyway, right? It's just how it works, right? Take a good thing. Yeah.
Take a good thing and ruin it with private equity.
The old last mover advantage, right? And that's what's your number? Yeah. So I do think that consolidation is going to continue to increase. However, I think and this has really already been true, you'll start to see or continue to see more and more of those individually branded and locally driven strategies. Because ultimately, not to say anything bad about Banfield, but I would say it's much easier to earn a bad national reputation in pet care than it is to earn a good one. Yeah. Because that's such a personal and sensitive relationship. And, people who have that passionate relationship with Dr. So-and-so at their local vet, that's really hard to kind of McDonald'size. So I think what it'll look like is consolidation will continue, and it'll probably continue to be, maybe even 50, 60% higher. However, I do think that look and feel will continue to be much more bespoke, and it'll be a lot more tech enabled. So you still feel like you're getting that local clinic. And honestly, I hope this to be true. I believe it to be true.
Right.
Yeah.
It's gonna be like, kind of tech enabled urgent care type of feel.
Yeah. Exactly. But I also truly believe that the veterinarian will play a much greater role in terms of their participation and their say at how the clinic is run, but then also their financial relationship as well. So they're definitely, vets are an incredible group of people who have probably the least amount of business training during their graduate school. You think doctors are bad, vets is like, it's another standard deviation over.
I think vets know they're bad though.
Yeah. That's probably the biggest difference is they're not, that's right. That's probably more an ego thing than training.
Physician doctors, They really think that they're good, but they're terrible.
That's right. So I think you'll start to see a lot more of these hybrid models where you say, hey, to the vet, rather than go accept, $90,000 to work for Banfield when you've got $250,000 in student debt. Why don't the demand is there, right? You can see that the trends are in support, but you don't want to go all the way out on that entrepreneurial operating ledge yourself. So finding that kind of facilitated way to go to market where you still have a lot of autonomy and control and participation in the upside, but also have that supporting model of a practice management group or, one of these chains that are thinking a little bit differently about ownership.
Cool. Thank you so much, Aaron, for coming on. We really appreciate it.
David, thanks for having me. It's been a pleasure.
We'll see how this turns out in a couple of years.
Yeah, absolutely.
A couple canned questions. What's your favorite book?
Oh, man. So now I'm the recency bias. We're expecting twins in 2 weeks. So I'd say the most practical book is Healthy Sleep Habits, Happy Twins that I've read. Man, favorite book that's a big question. Another recent one, but I just read a book called The Cold Start Problem, which is very germane to our business by Andrew Chen.
That's a big one, yeah.
Definitely took an incredible amount of that over the last year or so.
Couple twins advice for you. Night nanny.
Yes.
It's expensive, but do it.
Got super lucky. My sister's actually a nurse and has done some night nursing work. So I twisted the friends and family arm. She's going to come live with us for a little while.
Yeah. And if you really want to, go do it, the snoo. Let the artificial intelligent bassinet do the work for you.
I've heard of this. Yeah.
I just bought 2 snoos for 2 co-founders that just had babies because their sleep is very important.
I love that. Yeah. Can you write that off?
Yeah. I don't know. And then What is the best piece of business advice you ever received?
You know, I'm paraphrasing a little bit, but I think I tend to be a pretty analytical guy.
Mm-hmm.
And I think one of the things that I try to constantly remind myself is the alignment in the mission and the role that employees play and just people, the stakeholders in general. So I would say, probably twofold. One, your employees are your first and your most important stakeholders. And two, the analogy of the walking behind the tractor. So as an executive, to be as close as possible to the output, to really understand the feedback that your consumers are getting, to not get stuck in your own kind of echo chamber of, you can grow, but are you losing sight of adding value and delivering? I think those are probably the two most important lessons.
Love it. Love it. Everybody, thank you so much for tuning into the Capital Stack. We drop an episode every Tuesday on all your favorite platforms, YouTube, Apple, and Spotify. If you like it, please subscribe, leave a review, tell a friend, and we will see you next week. Thanks. Bye-bye.
Thank you for tuning in to the Capital Stack Podcast. Make sure to share this with someone you know that can benefit from this content. Remember to support this show by rating, reviewing, and subscribing. David Paul is the founder and general partner at DWP Capital. All opinions expressed by David and podcast guests are solely their own opinions and do not reflect the opinion of DWP Capital. This podcast is for informational purposes only and should not be relied upon for decisions. David and guests may maintain positions in the securities discussed on this podcast.